And we thank you all for joining us live. And that's our show for today. We'll see you next week. Just joking. This is take two. Sorry for the technical difficulties. Welcome to Pirates of Finance. We're very happy to be here at our new home at Blockworks. I'm Jason Buck. He's Corey Hofstein. We've got young Jack on the ones and twos. Nothing we say is an investment advice. This is for education, not education, actually, entertainment purposes only. Hopefully
Definitely not education.
Yeah. Hopefully we say something that we can string at least one sentence together. As you hear me, stumbling over my words, this is about what you're going to get from this episode. So I want to start off. We're going to try to hit some, kind of topical discussions of this week, even though Corey and I aren't necessarily topical guys. But one of the things we wanted to talk about was the saga that's been going on with Infinity Q. Now, I remember when Infinity Q started, it was obviously a fraud, and I kind of haven't followed it as closely since. But, Corey, what's interesting for me, I think, is that you're deep in this mutual fund space. So you're looking at like the construction and part of that saga, the story of like, how does this happen? So talk to me about Infinity Q. What did you see that really jumps out at you?
And sorry, Corey, can you just say like what Infinity Q is? Because some people may.
Yeah, I was going to start with like, who is Infinity Q for everyone who has never heard of them? Because I don't assume everyone lives in the same world we do, Jason. So Infinity Q,
this isn't crypto.
Yeah. Infinity Q is an asset manager that got really, really popular, particularly in the post-COVID crash days, because they posted some unbelievably spectacular performance. And when everyone was looking for the holy grail of a positive carry hedge, the Infinity Q mutual fund return curve looked very, very similar to that. So, Jack, I thought we're going to really push the limits of our technical abilities right out of the gate here. I want to share my Bloomberg really quickly.
Yes. So, are you ready to do so, Corey?
I am ready.
All right. All right. 3, 2, 1. Share it.
Wow, that was.
There we go.
How'd we do?
We did well.
Great. Thank you. So this is the equity return curve for the Infinity Q mutual fund. I'll highlight a couple of areas here. In the 2018 sort of VIX crash, it did particularly well. During March 2020, it did particularly well. You'll note that it stopped trading in 2021, and that's because there was an SEC investigation into the fund around the pricing of the securities they were holding. Now, for those of you who aren't in the mutual fund or ETF space, I should lay out some of the structure, which is that you normally have a fund advisor who's responsible for the actual investment strategy of the fund. And then you have a fund administrator that is often responsible for a lot of the legal, regulatory compliance, auditing. And for a very vanilla fund, let's say it's just long equities, the end of day NAV calculation is pretty simple. You just take the shares and all the underlying holdings, multiply by the closing price, add it all together, and that's more or less your NAV. This gets a lot more complicated when you start to talk about a fund like Infinity Q that had OTC derivatives. And in particular, they had quarter variance swaps. So, Jack, I'm going to come out of my share now. I don't know if we need a little 3, 2, 1.
Yeah, we do. 3, 2, 1.
Very clean.
There we go. Back
very
on
sexy.
Corey.
So you've got this fund that has within it these OTC derivatives. And you would potentially assume that a well-managed fund would have a third-party accounting firm that is pricing those derivatives. Sometimes the fallback, in my experience, is when a derivative or security doesn't have a price, the fund administrator will actually go to the fund advisor and request pricing. Well, it seems what happened in this particular case was that the fund advisor was providing pricing on all these quarter variance swaps, and the CIO of the firm was more or less changing their Excel models in real time to price them much more attractively. I guess the hope was the end game, that somehow things swung back in their favor and no one noticed in the interim. That didn't happen. The SEC came in and the whole thing has been unraveled as just this massive fraud, and that the prices we showed were not anywhere close to the actual value of the fund itself.
Corey, what do you think about, as far as like, ETFs versus mutual funds, right? And with the ETFs, obviously, is you need APs to make a market. And so does this belie that kind of like under the hood, like mutual funds, especially if you're using illiquid over-the-counter derivatives, that might not be the vehicle for this kind of product?
Well, I don't know if that's always the case, right? You can have an ETF where you could set up the basket that the authorized participant is trading to create and redeem as having a large cash component so that the authorized participant never actually has to trade in the OTC derivative, right? You could say our ETF is going to buy these corridor variance swaps, and the create redeem function is 100% cash, and then it's still up to the advisor to actually sort of price it. So it's a little weird. You probably need someone a little more knowledgeable on the ongoing intraday pricing and indicative NAV calculations of the ETFs. It might make it harder than for a mutual fund, but I guess if the fund is publishing those indicative NAV calculations and publishing what the basket's supposed to be, they could, in theory, still manipulate it if the market maker doesn't have to actually go out and buy and sell the underlying securities.
This is slightly tangential, but you and I have talked about this before. The idea with illiquid underlyings and liquid products, right? Whether it's ETFs or mutual funds. A lot of times people talk about this in bond space, right? You have a very liquid ETF that's trading in illiquid underlying market, and then we start to see those dislocations, right, in March of 2020. And there's kind of arguments on both sides about which one's actually providing real-time price. Where's the price discovery? Right? Is it in the liquid ETF structure, or is it really only in the underlying when it actually can be traded? I'm curious, like where you come down on either side of that.
Yeah, this one's come up a lot with like high yield bond funds, right? You saw this in March 2020, even not with high yield, just like core fixed income. You had with Vanguard their core US bond fund and their core US bond ETF, which is just a share class of the same fund, diverged in performance because of this issue, because the mutual fund NAV was basically not repricing on a lot of the illiquid underlying, and the ETF was trading at a discount to NAV because people were basically saying we don't believe what the underlying NAV is anymore because the market's totally broken and illiquid. I think the truth is probably somewhere in the middle. I think there is price discovery for the liquid vehicle like an ETF, but at a certain point, some of those ETFs turn into a hedging vehicle. So like something like HYG, which is probably the most popular high yield bond ETF, is an ETF that is utilized largely by institutions as a hedging vehicle. You can actually lend out shares of HYG, and historically, I have experience in this, earning like 70 to 120 basis points annualized. It's so in demand as a hedging vehicle. And so there's a part of in these dislocations, some of it I think is price discovery, and some of it is hedging pressure, which can push things beyond price discovery. Because again, in a crisis, a lot of actions that are taken are non-economic actions.
So your answer is C, all of the above, right? It's both price discovery. It's also illiquid hedge that gets pushed beyond maybe where it should be mark to market, et cetera. So you're straddling both camps. You're not going to get which means actually both sides are going to yell at us in the comments, right? And that's actually our hope from this show, is actually that we alienate both sides and everybody gets angry at us and everybody tells us how we're wrong. So by the way, Jack is checking the chat. So if anybody does want to yell at us and how we're wrong, feel free to, and we'll let kind of Jack take that on. When you're just talking about. Go ahead, so please.
Can I interrupt? Because I think that there's some parts of this SEC investigation, by the way, that are like, you read it, and again, these are allegations, right? This isn't like proven in a court of law yet. These are the SEC's allegations. Everyone's innocent until proven guilty, but these allegations are like, you read them and they're kind of insane. So this isn't even like digging into this 65-page document. I'm just on page 2 here, and I want to read a couple excerpts just to like give people some idea of how insane this was. So it says, unbeknownst to investors, Velasaris, who's the CIO, nearly inflated the Infinity Q Fund's stated valuations in at least 4 ways during the relevant period. He manipulated computer code. He entered inputs that he knew were incorrect. He selected certain valuation models in the pricing service that he knew couldn't properly value the positions, and he knowingly cherry-picked key valuation inputs, right? So this wasn't like you made a mistake. This was like a combination of different things, right? And this went so far that he was actually reporting different pricing in the mutual fund and his hedge fund for the same exposure. Like knowingly pricing them differently because the hedge fund didn't have to report every day where the mutual fund did. And you really have to question, like, what's your end game here? Once you're in that deep, like, I guess it's a Hail Mary on fraud. Like it's all going to blow up on you if you post the right prices. So in for a penny, in for a pound. I don't know. It's sort of a crazy concept.
Well, isn't it? It's everybody thinks like these things are so nefarious, right? A lot of times that they're an evil contributor from the start and they had this, master plan like Dr. Evil. But I always find it interesting. There's that show on CNBC actually that does a lot of like scams and frauds. And it's always fascinating to me of like, it's always like one minor decision that cascades into more minor decisions. And then next thing you know, like you just said, you've been there that like, and you probably rationalized and justified it the whole way down. And it's like, it's kind of fascinating to watch how those things manifest. But you also alluded to at the beginning that, what is our fascination with this stuff? Like, I think about like Catch Me If You Can, like was it Abernathy, and then the latest one on Netflix is Tinder Swindler. That's kind of fascinating. Is like the amount of elaborate ruse that goes into this. It's like you always kind of you in a way, for lack of a better term, like respect the elaborateness of the ruse and what went into it. But then you're like, why did you do it to commit fraud when you could have used that amount of creativity to do something legally?
So I want to read a little bit more and then I'll be done reading from this, but just to sort of like round out the full color here. So I showed in that graph how well this fund had done in March 2020. And as you can imagine, it attracted hundreds of millions of inflows after March 2020. Well, in March 2020, the CIO actually knew that they were internally incredibly poorly positioned for what was going on. They were about to lose a lot of money. And so he actually ended up stepping up his level of manipulation of all the underlying positions, resulting in an overvaluation of the fund's net assets by hundreds of millions of dollars. So just as an example, at the end of March, his mismarking of the fund's valuation led to a year-to-date return for the fund of being plus 9%. Right. So after March 2020, they were up plus 9% on the year. In reality, it actually should have been down 9% if you had actually used the true valuation of those securities. So this was something like they were already in trouble. And then he mismarked it so wildly. And by the way, down 9% is like, it's not horrible. It's not like this blew up. Like this is what's very weird to me. It's not like it was down 90. This was down 9 for the year. But I guess maybe, against what its purported goal was. So maybe that looked really bad. But at the end of the day, it's like, again, then all of a sudden it runs out of control because you raise all these assets on this mismark. And then what do you do? Because your NAV is hundreds of millions of dollars above where it really should be. And I don't know how you bleed out of that over time.
And part of that is, I think, like you reference is like, what does it say on the tin, right? It was essentially supposed to be a long ball fund where they said they were achieving positive carry. And whenever you do see that, and, we get confronted with this stuff all the time, is like, there's a lot of short ball positions, right? And so that's what you're saying is like in March of 2020, they should have been up. They were actually down because to achieve that positive carry, they had a lot of like hidden short ball. Well, it turned out like even more hidden based on, if you can mark your own models to market. Is then, what do you think though? What's the solution, right? Is it just a third party, that is auditing those actual results? Or like, couldn't you go to the banks that were providing?
There was a third party. There is a third party auditor. But they sort of like, my understanding of a lot of the third party auditing in this space is it's spot checks. And it's sort of like done periodically. And all of these swaps have like basically terms, right? Term sheets for what the swap is. And they ask them to upload the term sheet so they can replicate and price the swap independently. Well, he basically edited the term sheets in a way that made it so that when they went to price the products, it more closely aligned with what he was holding. So like the auditor it was a case of garbage in, garbage out. They were trusting that the term sheets they were getting were accurate, But if the person committing the fraud, of course they're going to manipulate the term sheet. So I guess it's a question of like, who do you trust in the chain at that point? The reality is what the auditor probably should do is go to the counterparty to get the term sheets. Right? Don't trust the person you're auditing, trust the counterparty to give you the term sheet would probably be a better way about it. But I mean, lesson learned. I mean, Jason, so you started this by saying you knew they were a fraud. Right? I don't know if that was just offhanded cheeky, but you sort of said like, yeah, like you came up against them as a competitor for a long time, knew they were sort of bullshit. I'm curious why you say that.
Well, I mean, to clarify too, I said when the news really first broke, it was obvious, it was an obvious fraud. That's what I meant. Like that's, and so I didn't really follow like how the fraud has come to light since then. But I do remember I actually have emails going back, so I can show this. Is like, we had a lot of people asking us questions about that, and I had a list of questions back about these swaps and everything like that. And if they couldn't answer those questions, which they couldn't, that really raises a lot of red flags and questions. So I wasn't necessarily calling them a fraud privately. I was just saying here's a lot of red flags that I had, clients or potential clients that were looking into them that said, here's who I'm looking at. What do you think? And I would send them back a list of like 6 red flags and, find these out for yourself. As you know, like just like on this, we can't provide investment advice. So it's more about, these are issues here. And it also belies like when we start talking about swaps and exotic derivatives, structured products, et cetera, like it's really caveat emptor and buyer beware. And you got to really, really know what you're doing there. And that's what I think, whether it's Infinity Q, whether it's Aimco in Alberta, these things, can happen, whether it's, going back to Orange County, right? Like these things keep happening over and over. And just like you said, the auditor maybe not getting your information from the CIO is like, this is what used to happen at Enron, right? With Arthur Andersen. It's like, how many times did we get it? Like, it's human nature. That's why I brought up, like Catch Me If You Can or the Tinder swindler. Like, this is just kind of like part of what it's like the eternal recurrence of what we keep seeing in markets and everything. I want to change tacks a little bit for like, we were talking about liquidity a little bit with like the high yield ETFs and everything. And so what it has come to light a lot of that's been in the news lately, and especially the last, Q4 last year going into this year, is a lack of liquidity in markets. So obviously, somebody that has, is part of a long vol fund, obviously, you hear lack of liquidity in markets, and I'm going to be like, yes, I want to just agree with that, right? And we start talking about like, if people look at E-mini order books, the ES, basically the S&P and futures, is, we go, there's a lack of liquidity in the order book. Now, that would give me confirmation bias, but I can't help myself. I want to look for the disconfirming bias. And so part of that, though, that my pushback on that at least would be that, you're just seeing the order book, right? And so you're just seeing like kind of the tip of the iceberg. And now we have all of these algorithmic traders now that can put in your orders in different ways, where you can have iceberg orders, et cetera, where you're just basically hiding kind of where that is in the order book. Now, is that the case? Is that what's going on, where like actual order book liquidity looks low because people are stepping in and really trying to hide their orders? Maybe. Also, I mean, I think that, the exchanges have pushed back and said, look, there's still liquidity there. We just the bid ask spreads might widen, but you can still get off that liquidity. Other people would argue with that too. So the question is like, is there a lack of liquidity, let's say in the E-minis, where most of the dealers and market makers are using, that's where they find their hedges for, their derivatives products. And the other one that, actually I had traders texting me today about is they're seeing a lack of liquidity in credit and rates. And so, it's always interesting if you're just, watching the average news, you're going to hear about the Fed is, money printer go burr and they're injecting liquidity. But traders in actual markets are finding a lack of liquidity. And like I said, I always am hesitant to have my confirmation bias look for that lack of liquidity. But I'm curious kind of like what you're seeing, Corey, as well.
Yeah, this is one of those areas that I will freely admit I start to get out of my depths. I have seen a lot of color from the sell side, as well as you're starting to hear a lot of chatter from the buy side over concern about equity market liquidity in particular. That it is at some of the lowest levels it has ever been historically, starting to reach levels actually lower than it was in March 2020. And yet you compare that to some other analytics like those provided by Squeeze Metrics, where you can look at their dark pool indicator that suggests you are getting unbelievable equity bids.
Unbelievable.
Right. So I think
like
highest prints ever and some of their total like volume metrics. And it's all occurring in dark pools, right? So it's not hitting sort of the top level liquidity of the order book of what's at least resting there. And so I think this becomes a question of, again, around market structure. Is market structure just different today? Is comparing resting order books today to 20 years ago even relevant for the way markets work? Is a lot more activity happening in derivatives than is happening in the futures? What's going on in cash markets is another question. I don't have a good answer here, honestly. It's frightening from the perspective of, okay, if you believe lack of liquidity implies faster moves in potentially both directions, it seems like, wow, that this, it's like the machines have pulled the plugs and this is where things fall apart. And yet markets keep ticking. This is an area that I feel like there's another answer that I'm not aware of yet. And no one's really brought it forward to me. But it is like it's great bear porn, right? From the sense of like, oh, liquidity's dried up. This is like gonna be chaos.
Right, that's what I'm saying. For me, it's like you said, bear porn is like with long volatility. You obviously, you really want to believe there's that lack of liquidity, but I always have to like second guess myself and have that little bastard on my shoulder goes, "What if you're wrong?" And try to find some disconfirming evidence as well. But I wonder too, like if somebody probably would overlay that and say that's why the VVIX, the volatility of volatility has been higher. We've seen like these, quick sharp moves down and quick moves back up, and that can also be part of a lack of liquidity in markets. That's making that sharp mean reversion happen at a much faster rate. But once again, we don't know. And then I also would like to disaggregate so many things in liquidity and overlay OPEX, everything, to see like how hedging and everything is affecting liquidity. Especially in the like after OPEX in the last week of the month, what are our liquidity parameters kind of looking like?
Yeah, if I may,
Jack,
the VVIX, I mean, you can see the incredible upsurge in the volatility of volatility, such as like, the VIX is up something like 20% over the past 2 days. And, Jason, I'm wondering to what extent that's over Ukraine. What do you think about that?
Just blatant setup. Well done. You almost got it off with a straight face. And Jack's trying to do that because we joke about quoting VIX and percentage moves. I mean, it's really just in handle moves, and the VIX is really used on those Vega handles for people to offset their positions. So that's why actual percentage spikes in VIX don't really mean anything, because once again, VIX is untradeable at the spot market. And then as far as it's Ukraine, once again, that narrative fallacy of trying to apply any sort of move in the market, trying to find a causal link is nonsensical, especially over the short term. Jack, do you have anything to add to that, or you just like to get me on that one?
I just like to push your buttons. Yeah, like for a long time, I've known that quoting VIX in percentage terms is a way to make true market experts instantly know that you have no idea what you're talking about. But I didn't really understand why it was inappropriate to quote VIX in percentage terms. Corey or Jason, do you want to maybe provide a little insight on that?
Yeah, I'll try to explain. Fixed strike ball versus floating strike ball. And I'll try to do as simply as possible using a toy model.
Volatility.
So let's say, volatility. And please always ask us to define terms. Is if you think about, the VIX, you're measuring volatility today, right? So let's say the VIX is at 10. But you have to pay up for implied volatility to buy a put on the market. So let's say you want to buy a put that's negative 5% down in the S&P 500. And the implied volatility you're going to pay for that is 15, right? So current VIX is at 10. You're buying a put, let's say a month out, negative 5% down. You're paying 15 for that, right? So that's why your fixed strike vol that you paid is 15, right? Floating strike vol with the VIX index is at 10. So let's say the market moves down towards your negative 5% out of the money strike. And so then your floating strike vol with the VIX index has gone from 10 to 14. You'd go, wow, the VIX index or volatility is up 40%, right? But you paid 15 for that position. So that's your fixed strike vol. So it's actually gone down from 15 down to 14. So you're down 6.5%. So that's really the difference between fixed strike and floating strike vol. And another way we think about that is like, you basically, implied volatility or skew is what you're paying for that protection. It doesn't really matter what the VIX is implying at the money that day. It's what are you paying for? That implied volatility, what you're paying, and then realized is what affects your P&L over time.
Yeah, I'm going to take this from a totally different direction, which is that it just doesn't even make sense mathematically to quote changes of a percentage point in percentage points, right? I mean, at least from an analytical perspective, what you're looking for ideally is a stable distribution of changes. And the reality is going from 5% implied vol to 10% implied vol is a much easier change than, say, 50% to 100%, which both are, in theory, 100% changes. What we're really caring about is percentage point changes, right? We're measuring this in percentage points, and therefore we need to quote the percentage point differences. The same way you wouldn't say my P&L is up 20% on the year, and if it goes to 30%, you're not up 50%, you're up 10 percentage points. When you're quoting percentage points, you quote it in the difference, not the percent change. It just doesn't make any sense analytically. Can I roll back really quickly, though, to the conversation about liquidity? Because I have another graph, and I really just want to press Jack's technical abilities. I think this is fun for me, especially on the first episode. See what we can break. All right, so we got the old Bloomberg up and fired up again. So what we have on the top here is the VIX, and on the bottom we have this Chicago Fed E-mini S&P futures market depth measure. And one of the things you can see that like got weirder post Volmageddon, sort of that February 2018, late January 2018 period, is you used to have this like very small negative impact. And this basically measures how much market impact are you going to have for trading 100 E-mini futures. You can see that it dramatically changed in absolute size. And then you can see more recently that it has gotten much larger than it has ever been. And these spikes have also gotten increasingly correlated with changes in VIX. This is something that there's a guy on Twitter. His name is blanking on his name. Hold on, I'll get it for you right now. Stretching Spreads is his handle, and he pointed this out right after March 2020. And the relationship is held oddly persistent out of sample since he pointed it out. So there is this, at least the way different parties are measuring it, this situation right now where it seems like less volume is creating more impact in the markets, which might explain a lot of this massive intraday volatility that we're seeing.
That's a great way of putting it too. Like if you look at like close to close, you're not seeing a lot of what's actually going on under the hood. There's a lot of intraday vol in between. That's interesting. Also, I want to put out, did you say since Volmageddon in February of 2018, and then you just said March of 2020? So I just wanted to clarify.
So what I was pointing out in the chart is this like relationship seemed to change after Feb 2018 Volmageddon, when that XIV ETN blew up. And then this was pointed out to me by someone on Twitter. Their handle is Stretching Spreads, who posts a lot about these liquidity issues, pointed it out post March 2020 is when it came on my radar. A lot of times this stuff gets pointed out afterwards and it then falls apart out of sample. This is a relationship that seems to have persisted afterwards as well, which is a little unusual. So I give it a little bit more credence in my, okay, things seem a little weirder than they were in the past. But again, this is just an analytical model. It could be failing to capture the way in which market dynamics have actually evolved and participants are actually trading.
Well, then the even harder part is the Keynesian beauty contest, right? Is like, a lot of people like Mike Green and everybody have been pointing this out, and Chris Cole, since like Volmageddon, you've had that lack of liquidity. But, if you start trading for that lack of liquidity since 2018, you've kind of gotten smoked besides like, March of 2020, so it's really interesting is like, is that liquidity there? When does that liquidity break? It's just like everything. It's like you can get the direction right, but the timing wrong.
Well, I'll only push back on that and saying lack of liquidity just means less volume would imply a greater price move. That works to the upside as well. Right. So you could argue that these massive positive moves we've seen in the last couple of years can be from the same cause. It just could be we have a latent large down move that could occur at any time if sort of the tides shift significantly.
And Speaking of those feedback loops, I couldn't help myself. When you pulled up your chart, I actually thought we were looking at the ARC chart at first. So if you want to,
Oh, we can do the ARC chart if you want.
If
Great
you want to
transition,
roll the
Jason.
ARC chart,
Let's do that. Yeah,
nice.
let's talk about that.
How do you want to dive into ARC?
Well, I like as Corey's pulling up the
other
chart.
than, wait, okay, did you see Kathy went on CNBC? 2 points I'll make.
Yeah.
One, I love that they at least give her like 45 minutes to talk. I do think that's great that they can actually do an in-depth conversation with a manager for that long. But it was funny that CNBC hadn't paid for Zoom. So she like got cut off halfway through and they like the free trial ran out or something like that. That was pretty funny.
Hey, Corey, who does that remind you of? Just real quick.
I was like, is that a subtle dig at Jack?
I wasn't going to say anything, Jack. I wasn't going to say anything about how many times did it take for us to get it this right without, I mean, we don't know. We'll see in 5 minutes whether this cuts out.
No, we're good. We've been going because we started the call before we went live. Yes, on the prep calls that we were doing, I had not paid for Zoom Pro, so shout out to Carolyn at Blockworks for setting me up with a pro Zoom account. So we can go as long as we want. So yeah, I think ARC, Corey and Jason, you guys, the Pirates of Finance, the Mutiny Boys, you guys had made your second video, which is so freaking good. I think it came out on March 10th or whatever of last year, and it was about structural issues that you were it wasn't like all rigorous things. It wasn't on one side or the other, but it was pointing out structural issues with ARKK. And Corey, you did an analysis, and you took the stocks that ARKK, that ETF, but Kathy Wood owns the most of. In other words, where they had 7, 8, 9, 10, 11% of the free float was owned by that ETF. And you
30% in some cases.
30%, yeah. And you compared that to other stocks where ARK ETF only had 50 basis points or 1%. And if you said if you had a basket of going long the ones that ARKK had a small percentage of and short the ones that they had a big percentage of, that would have been an extremely well-performing portfolio. So yeah, also Corey, most people in the media.
So let me clarify that, because that wasn't quite it. So this whole big question, by the way, is like, this is not a dig at Kathy in any way. The whole big question is, when does a strategy no longer fit a structure, right? Kathy has an investment strategy. The ETF is the structure she delivered it in. Are there problems sometimes when a strategy outgrows its structure from the amount of assets you raise? That's the question. This is not meant to be a dig at Kathy's strategy, their analysts, anything like that. The analysis that we did was to say ARC, as well as the SMAs run by ARC, so the ARC ETF, ARKK, the SMAs, as well as the mutual funds that she sub-advises in Asia, owned a massively disproportionate amount of some of the names, 20, 30, 40% of the outstanding free float in a lot of the names that they owned. And the question was, all of the inflows that they got in Q3, Q4, 2020, was that having a positive feedback loop that as they bought more because they had sort of constrained the supply, they were pushing up price disproportionately? And so the study that I did is I broke their holdings into two groups: those that they owned a disproportionately large amount of, those that they didn't. And then I used a crystal ball, knowing the flows that came into the ETF. If the flows came in were positive, I went long the group that they owned more of, right? That they had constrained supply and therefore I thought would have an outsized price impact, and short the other group. And then if there were outflows, I did the opposite. The whole idea being flows was going to dictate the relative performance because they had cornered the market. And so when there were inflows, it was going to create positive pro-cyclical effects. When there were outflows, there'd be negative pro-cyclical effects. And what I found was that there was really no positive performance in that strategy until about Q4 2020, when ARC started to see massive daily inflows. I mean, I think it was to the tune of like $100 to $500 million a day that they had to put to work.
At one point, it hit 1 billion in a day.
Yeah, that they had to put to work, and were not like straying from their strategy. They weren't saying, we have too much money coming in, we need to buy SPY just as a liquidity pool while we put this to work. They were just plowing it into their strategies, into their holdings in many cases, because that's what the authorized participants were supposed to do. This is an ETF. So as there's demand for the ETF, these authorized participants are just buying up the underlying, which in turn, the argument is it made the performance of ARK look even better, which invited more inflows from performance chasers, which made the performance look even better. And so the argument was this performance is sort of self-created. As the marginal dollar of inflow disappears, the performance will taper off. And then as there are outflows, it might work in reverse. We certainly saw that performance for ARK has come down. Interestingly enough, and Jack, I'm going to push you again to do a screen share. They have not seen the outflows the way they saw inflows. Let me know when you're ready, Jack.
Yes. Let's just first of all let people in the chat let me know if your audio is working. And since I've sort of hogged the speaker, let me just break it down. So like ARK obviously had made an incredible call on Tesla, and they own about 10 to 12% of it. But as Tesla goes up, they're selling off Tesla because otherwise Tesla would become like 90% of the fund. Likewise, when you have these very small stocks, ARK can own 30% of all of the stocks can be owned by them. So when money comes into ARK, it has to keep on buying them, and then that can drive up the price, and it's self-confirming. And then we're going to foreshadow a little bit, but that can work in reverse. So Corey, yes, we can now share the screen. Ready in 3, 2, 1.
And we really got to work on the screen share.
Yeah, I know. We'll get there. So again, we're back to the Bloomberg. And what we have here in the top of this graph is just ARK's total return over time. Sort of peaked here, Feb 2021. And what you can see on the bottom is their cumulative inflows, right? So you can see this did the classic sort of like exponential rip where it just absolutely peaked in assets during this Q4 period, initial Q1 period. And the question was, were these assets what was actually driving performance? And a lot of our conversation in that video, Jason, was if it reverses, it could be pretty violent, that you'd see the inverse situation happen. Interestingly enough, while assets have come down, you haven't seen a mass exodus from ARK. Investors seem to just have bought, and my guess is from a behavioral perspective, they're already down so much that they're not willing to sell at this point. They're saying, whatever, we'll just hold, or they're true believers in Kathy's strategy.
Yes, sorry guys. So the light blue line, that's sort of a bar that's filled in, where it says accumulation, that is essentially the fund flow, the cumulative fund flows for ARK. So how much money has been put in? As you can see from the start of 2020 to it's like March of 2021 was about the peak. There was a huge upsurge, and then the chart on the top was the price. So it's the price was it the price drawing in more fund flows, or was it the fund flows driving up the price? And then the green bar is just the daily fund flow, or I guess it's the weekly, or
that should be daily.
Daily. Okay, yeah.
So part of that too, though, is, like Corey was saying, in fairness, when we talk about this eternal recurrence of everything happening over and over again, and we referenced, I think in the video, like Janus funds of the late 90s, right? That kind of were part of the .com boom and bust. But then actually 10 years after that, like going into the 2000s, Janus recovered just fine. But part of, like Corey was referencing, is that it's more of a Kathy structure at the ETF. She can't say like, hey, we got enough money, let's shut this thing down. It just doesn't work like that structurally. And then also shout out to our mutual friend, Dr. Dark, that also pointed out, like, this is what happens also when you create basically a liquid ETF for VC investing, right? So you're going to see kind of, a lot of volatility just, across those, especially illiquid or low float stocks. But the other thing I want to point out, and I'm going to get a yellow card for bringing up ergodicity on this, but because I'm also forgetting the right term for like almost like dollar weighted returns. Is that the right word? Like phrase, Corey, is like, it's always interesting looking at this is like, how many people that invested in ARK are actually underwater, and especially like on a dollar weighted
if you give me a minute, I can pull up that graph. A great narrative. You had a lot of people chasing into the COVID era without any idea how long COVID was really going to be around or how effective vaccines were going to be. You saw positive repricing because of that. And then when vaccine news was better than expected, you started to see a rotation back into real economy businesses, value. Then more recently, it's been the inflation concerns over the monetary and fiscal stimulus we saw during the COVID era. So is Kathy's performance because her company's got sort of this positive feedback loop and therefore got pushed well above their justifiable valuations? I mean, I think in hindsight, we can say they were pushed well above their justifiable valuations, but Kathy would probably disagree with that, right? So who knows? Maybe she'll have the last laugh in 10 years. Again, I'm not here to question her approach or her strategy, but I do think for anyone managing money, it's always a question of what is the right structure. I very frequently get asked, as I'm sure you do, Jason, about, well, why isn't your strategy in a certain type of vehicle? Why isn't it a hedge fund? Why isn't it an ETF? Why is it in a mutual fund? And it's not as simple as one vehicle is better than another. There are trade-offs for every vehicle. And one of the downsides of an ETF is that you can't close it. And if your strategy is to own a large share of these smaller, less liquid companies, then not being able to close it when you get massive inflows can be a problem.
Yeah, speaking of vehicles, I was right now I'm reading Sebastian Mallaby's new book, like Power Law, about like the start of the venture capital industry. And you're just pointing out the cues reminded me also of an article I was just reading recently on Substack by Abraham Thomas, and hat tip to my partner Taylor Pearson for sending it to me. But it was about Minsky moments in venture capital, right? And the idea of Hyman Minsky was that stability breeds instability, right? As time goes on and markets that were once more volatile, as money flows in, that money has a reflexive feedback loop that reduces volatility as the inflows are piling on top of each other, until that stability breeds instability. And as soon as you have a crack, it cascades kind of the other way. And, Abraham was actually talking about this idea of, in venture capital, is there a Minsky-like moment? And people would be like, well, you don't have like leverage, what vehicle are you in? The illiquidity, all that stuff doesn't matter in venture capital. But it was kind of interesting, like I was referencing ARK being almost like an ETF for venture capital. Is like now when you have like the Tiger Globals of the world coming in and trying to make those IRR turnovers a lot faster with just like 2-year cycles, it's more like a timing that creates a Minsky-like moment. So as these as they go through, series C, D, E, F, and like they're getting marked up higher and higher and higher, all it takes is like one down round for it to start to cascade lower, right? Or like you were just referencing is like, when did the actual investors come into ARK, right? If you're coming in on these late stages into venture capital, which just seems like everybody is a venture capitalist these days, or at least a seed investor, is like all you need is one down round or one markdown to kick off like a cascade like event. And what I find interesting, because you brought up the cues as well, is like what happens is if those returns aren't as potent as they've been in the past, because we're always looking in hindsight, and somebody just looks up the triple Qs and they go, wait, I could have been in a liquid vehicle that outperformed my venture capital. Like how much of those outflows then come out of VC? So it's, even though it's not a traditional Minsky moment, which is usually built through credit and leverage, it's a very interesting way of, to me, the parallels with ARK too, is like when you just have massive inflows in anything, that stability breeds instability, and nobody sees the, once again, it's really hard to time when that instability has a cascade effect.
Did you happen to listen to Howard Lindzen's podcast
Yes.
with Joe Wise? Okay, with Joe Weisenthal and Tracy Alloway on Odd Lots. I thought it was Howard's always great to listen to. He's such a fascinating character, always entertaining and insightful. If people are interested in what's been going on in private markets, which have also been so crazy over the last couple of years, I highly recommend it. I just listened to it this afternoon. I'll try to distill it as best I can, but what Howard was basically saying was that, your Tiger Globals of the world started to act in such a way that they were pricing everyone out of rounds. And they would come in and say to a company, we want to give you $300 million. And the company might say, well, we don't want that much money or deserve that valuation. And Tiger Global would say, if you're not going to take it, we're going to go to your competitor across the street. And so they were bullying their way basically onto the cap table. And then you basically had an entire sort of set of copycat funds do the same thing. And it led to these sort of insane valuations. From an economic perspective, what didn't get talked about in the podcast, but you've talked about it in the past, Jason, is this idea of when employee compensation is a large part of it, particularly in the tech space, is done with options. And those options are tied to the value of the firm. And all of a sudden, employees start to see that huge part of their compensation get lit on fire as there are private down rounds, or there's no ability to get liquidity ever because these companies aren't going public, or they're going public and the stock price is crashing. How does that sort of affect the way employees behave going forward? I think the 2010 era was the era of pay me in equity, and I'm not sure pay me in equity is as great as everyone thinks it is.
Yeah, like who wants to be paid in Peloton stock these days?
And what does that do for retention, right? How does that send a company into like a death spiral when you can't retain employees anymore?
That's why I highly recommend this Abraham Thomas on his Substack, because that's exactly what he went into. Is like you have that Minsky cascade or liquidity cascade, a la Corey Hosteen, where it's basically that feedback loop feeds into itself, right? If your options are getting marked down, employees are leaving, they're going to better offers, mercenaries are coming in, then the value of the company is going down. Like you just end up in this death spiral. Like you said, there's so many things that Howard talked about in that one. I thought that was really interesting, actually, was like he broke down the first time I've really heard it about as seed stage investors versus when the SoftBanks and Tigers come into the world, they're basically dictating those terms and that liquidity. So they're absolutely screwing over the seed investors, and they just have to be along for the ride. And yes, they might be marked, to the latest mark of whether their value's at, but they actually can't sell their position. So they just have to, almost like you just said with ARK, going that round trip. They have to watch their investment go round trip now because of the covenants that the Tiger Globals and the SoftBanks at all of the world have kind of put on and it's going to take a new breed. It's going to take probably a crash in that till a new breed of entrepreneurs and seed investors rewrite kind of the rules, almost like a different vehicle, like you're saying. I guess Jack's got a book that's talking about this.
Say, Jack, you going to read a book? Are you bored?
Shoot. Hey, okay, I just realized that my audio's been off the entire time, so Corey and Jason have been able to hear me, but no one else has. Okay, so this book, somewhere in this book, Peter Lynch, and you guys are going to have to hear me again, Peter Lynch says that the Magellan Fund, it was too big. People said that the Magellan Fund was too big at 1 billion, it was too big at 5 billion, at 2 billion, at 10 billion to generate positive returns, good returns, essentially making the same allegation that people now say about Cathie Wood's ARKK. But a difference is that Peter Lynch's Magellan Fund was a mutual fund, whereas ARKK is an ETF. So it'd be great if we could go over, for some people who don't know the differences between a mutual fund and an ETF. Corey, you talked about authorized participants. Corey, how about you? You're kind of a technicals guy. How about you start off? What is the difference between a mutual fund and an ETF, and why might what people are saying about ARK be true about ARK if it wasn't true about the mutual fund? How is ARKK different than the Magellan Fund?
So mutual funds and ETFs are both registered investment companies. They more or less do the same thing in purpose, right? You're investing in a basket of securities, and there is an investment strategy that's associated with that basket, and you buy a share that represents your collective allocation within the larger pool of assets. So at face value, they're really not that different. The big difference is how cash flow comes in and out of the different vehicles. So in a mutual fund, you basically buy the fund, and the manager wakes up with a cash report, and cash has shown up in their bank account. And so they get a statement saying, hey, you have X new dollars, or you have X amount of redemption, and they have to trade to that. But it doesn't trade intraday, right? So what you are getting when you buy and sell is the end of day NAV, the net asset value that gets calculated. With an ETF, it is trading on the exchange. And so when you go to buy an ETF, you may actually be buying it from someone else who's selling it. And that money may never go to the manager. It might be Jack owns an ETF. Jason wants to buy it. They meet on the exchange. Jason buys it from Jack. The manager never sees the cash flow come in and out. Versus with a mutual fund, if Jack wanted to buy and Jason wanted to sell, what would basically happen is you would have cash coming in, cash coming out in the manager report. Cash might offset, but it's going to show up in the actual cash report for the manager. So the ETF, what happens is when there is an aggregate excess of demand to either buy or sell versus what can actually be traded on the exchange, there is a market maker, someone called an authorized participant, who looks at what is in the ETF, sort of the defined basket of assets, goes out and buys all those assets, and then goes to the ETF sponsor and says, here's all the stocks, please give me some shares. That's called a create. And then they'll go to the exchange and sell those shares. Conversely, when everyone's maybe trying to get out, what they will do is they will buy up all the shares as people are trying to sell, go back to the ETF company and say, here's some shares, please give me all the underlying. And they take the underlying and then sell the underlying. That action of trading the shares for underlying is where the big tax loophole comes in terms of ETFs being able to operate in a very tax efficient manner, because the ETF manager can choose which lots they're pushing in and out. And so they can push out, for example, those lots with a very large embedded taxable gain in them, and that can save them a lot of money from an actual management perspective. What's the big difference? Like if Kathy were an ETF versus a mutual fund, nothing actually. It's the only difference that would happen is if she felt like she was getting too big, you could close the fund when it's a mutual fund and say, I'm not taking any more money. You can't do that as an ETF. And so that is the only difference really in terms of managing the assets from the perspective of what Kathy was doing. Arguably, actually, you might be able to say in the early days, it's even better to have the market makers trading the securities, because the market makers, there's 20 or 30 of them that'll trade in ARC that they can work with. And they almost act like a capacitor. Like they have their own risk books. And so as Kathy's trying to enter or exit a position, those market makers are trying to trade that position as efficiently as possible, have as minimal impact as possible, but they're also willing to potentially hold a position on the book. They don't have to liquidate it immediately. The mutual fund, the trading is actually happening by traders at the fund. And so the question is, are they as good as the market makers? Are they going to have as much or as little impact as the market makers? They can't hold risk on the book. You're sort of disaggregating who's doing the trading with the ETF. So there actually might be some efficiencies there. But again, for Kathy, the big difference is you can't close the fund. If too much money comes in, oh, well, you're stuck. That's it.
You can't close the fund. And that's why in the video you had 11 months ago from both of you, that you started with Jim Cramer saying, Kathy Wood should just close her fund. And yes, you said that's not how an ETF works.
I mean, it's almost insulting that Jim Cramer doesn't know you can't close an ETF. I don't expect everyone to know everything, but for a guy who's going to say as bombastic things as he does, he should probably know the basics of vehicle structures.
Corey, do you think that part of that though is then maybe we could potentially see like a Kathy Wood rule that like ETFs in the future, her firm could push for, like the ability to close your ETF structure to more like that's a simple way to kind of solve that problem?
Yeah, I don't know how that would work. I mean, I guess you could close it like with an ETN. You can say we're just not issuing any more debt, and then people just will trade above and below premium. I'll leave that to smarter people than me about market structure to figure out whether that could work. But you have seen her file for a closed-end fund, or maybe it was an interval fund. I can't remember which one it was. But either way, a structure that would give her a lot more, I think it was an interval fund, a lot more control over the liquidity, which is exactly what she's looking for.
Yeah, I think about this serendipity this week. You know, I wasn't even thinking, I was reading this Abraham Thomas article on Minsky moments in VC, happened to be reading Malaby's book. Like you said, just Howard Lindzen was just on, you know, on Bloomberg podcast. And then, you know, I didn't know we were going to talk about ARC today, but all that, you know, kind of meshing up in my mind, and also with the triple Qs. But one thing that came across my desk, I was like, oh, let me go back and reread some stuff about Masa-san, Vision Fund and everything. Do you know how much Masa lost in the .com bust?
I have no idea.
$70 billion.
That is so much money. Wait, can I ask you a question, Jason? This is going to take a total left turn, and I know we're bumping up on an hour here, but how do you consume so much content? And that's like a legitimate question. I'm actually like, you of anyone I know, send me more articles, more podcasts, more YouTube videos. And there are people I know that consume a lot of content and don't retain it. You consume and retain in an incredibly impressive way.
Flattery will get you everywhere, but I'm not sure this is necessarily flattery. But no, the way I think that life has been good to me in the sense that like podcasts you can do 2x speed, right? And now YouTube you can do 2x speed. And then I always had a love and passion for reading. And then I think at the end of the day, for me, it's also insatiable curiosity. So that's the retention part. Is like I'm really curious about everything in life. So when I'm reading, watching, listening to stuff, I tend to retain a lot of it because also it applies to what we do for work, right? And so it's
like
like
a process of finding stuff though, or is it just stuff you randomly come across?
no, that's what I think is the key is like there's no systematization to it. It's harnessing that insatiable curiosity. So it's wherever my curiosity takes me, I'll listen, watch, whatever. And so that's I'm never like doing homework, right? Like if I did homework, I probably wouldn't retain it or want to do it. And then the other piece to it is like I have no life, right? Like outside of work, I'm listening and watching things at 2x speed, like wherever I'm doing. So I'm walking a lot, listening at 2x speed. So like I was actually joking the other day, by the time I got done with my walk and my coffee in the morning, I'd already listened to 3 podcasts. So that's more than most people do in a week right there. And that's one morning for me. And so, and then at night, same thing, reading, watching YouTube at 2x speed. I need to start training myself to get up to like 4x speed or something like that. The problem is when I read though, I read so slow. So I wish I could figure, I don't like speed reading though. So
I'm the opposite. I can't understand any podcasts because it goes over my head. So I listen to it on half speed.
Speaking of YouTube, I think we have to say like, subscribe, share with your friends, hit the bell. What else are you supposed to say?
Yeah, smash the like button, smash the subscribe button, leave us a comment. And, I think a lot of people have already said that, Jack, your audio is messed up. What's going on? This is Jack, you need to fix it. Okay, so tell us that, but also tell us, what do you want to hear on our next episode? We should say this is Pirates of Finance, and it's pronounced finance, not finance. Yep. And we will be here, everything goes to plan every Friday at 3 p.m.
If Jack can figure it out.
Yes. Jason and Corey, as we want to leave our audience, do you want to just leave a parting message that our audience can sort of mull on over the weekend of why call it Pirates of Finance? What do you want to do with this show? How do you want to, what's the intellectual journey you want to go on with this show? With you, Corey, and you, Jason, talking to each other, as well as, what do you want the audience to take from it?
Or do you want to go first? Do you want me to?
Yeah, I'm happy to dive in. Look, part of this was just it was serendipitous. I'm living in the Caribbean at the moment. I've always enjoyed the lore of pirates. Jason runs a firm called Mutiny, so pirates was a very natural term for us to use. But I think we're trying to embody that spirit a little bit, that freewheeling natural spirit. Finance can be a very, very stuffy industry, and it should be serious. We take our roles and responsibilities of managing other people's assets very seriously. But it doesn't mean we can't have fun in discussing these topics and allowing a little bit of lateral exploration and just sailing the open seas of our interests. So for me, that's what this is all about.
Yeah, I think Corey nailed it. And I'll just highlight it is like when we started the original YouTube channel, we were throwing out ideas for a long time. And I was trying to get Corey to do a podcast with me for a long time. And then we had a mutual love for YouTube and vlogging and some of the more interesting things on YouTube. And so we thought it'd be really interesting initially to do all these videos on YouTube where they were slightly irreverent. And we just felt that like a lot of people in our space are way too buttoned up, at least publicly during the 9 to 5. And then afterwards, they're very interesting, lighthearted, and irreverent as well. And so we were willing to play into that a little bit when we were doing those YouTube videos. And then as far as this show is concerned, we wanted to kind of talk about things that are semi-topical, what's going on the week, that at least give us an impetus to talk about things. But we want to bring to light, a lot of the conversations Corey and I have privately, and we feel like, a lot of people are, as soon as that camera turns on or that mic's on, everybody all of a sudden becomes so serious. And so there's a way to talk about serious topics, but maybe in a lighthearted fashion. And like we said, we're just two idiots speculating on, what's actually going on and trying to figure out how the world works. But we don't mind showing that in real time. And we hope that, the audience, if there is any more than probably 3 people watching this, that will also enjoy our particular brand of banter or humor, even though I feel I'm humorless and it's actually on Corey's side of the equation. But otherwise, we're excited to be working with Blockworks and have this new home here. And, shout out to all the producers behind the scene that make this, as effortless as possible. And young Jack, as always, on the ones and twos, except for, next week, hopefully we can get his mic to work. But otherwise, like you said, we'll be back hopefully every Friday live at 3 p.m. Eastern, noon Pacific. And we really look forward to, as Jack said, please, comments, etc. Let us know what you want us to talk about. This is generally about community at the end of the day. We're not trying to tell you how to trade or what to do with your life. We're just trying to have a discussion, a lighthearted discussion, so you can enjoy your Friday going into the weekend.
Yeah, definitely. I think while you guys are very lighthearted, I think there is an intellectual rigor that both of you bring to the table, and the video on ARK that you guys posted, it's just so criminally underviewed. That really is a glimpse into the true dynamics of what's driving ARKK, at least some of them. And to me, at least, I'm like Jason, I'm an avid consumer of financial content, but I'm also a producer of it. And so I just watch what other people are doing, and I think it really does kind of bum me out that so many people were just we're so very eager to crown Cathie Wood as the queen of investing, and now that the fund is down, they're just sort of trashing her and making it very personal, and I don't really like that at all. So I respect both of you guys for actually just talking purely about the liquidity dynamics and keeping sort of personal attacks or praises outside. Yeah, Corey, sorry, you want to say something?
I was going to say, Jack, I hope you're getting ready to roll the outro.
Oh yeah, I'm getting ready to roll the outro.
I didn't even know we had an outro. I was just going to put you on the spot.
Oh yeah, wow. Well, I could be bluffing. We'll see. You guys got to follow Mr. Corey Hoffstein at Choffstein on Twitter, at Jason Mutiny on Twitter. Follow at Pirates Finance. We got to get that account rolling again. Of course, follow at Blockworks_, and I can be found at Jack Farley 96. All right, you ready for this outro? Let's see if we got it. 3,
Let's do it.
2, 1, go.